Hello, hello. Let's talk about NIO, a favorite of the stock market community, and for good reason. The company and the stock, actually, basically, has been performing awesome in the previous months, yet it has fallen off a cliff lately, losing 50%, almost 52% of its previous value of its 1 year before. And believe it or not, I was looking at NIO back around here. I still remember it. I remember the company being at $6, and I was thinking of pulling the trigger. I never did, but the reason for that is it was basically Tesla back then. Just because of Tesla's success, I was thinking maybe that will be a sympathy play, as we call it. In case you are not aware of what that means, a sympathy play is basically when picture a company that is having earnings, an earnings report that does awesome, and that company is in the IT space. Generally speaking, all the companies that are like competitors to that company tend to get a little bit of an increase in their price as well, just because they are in the same market, and potentially a massive explosion of that company signals that other companies in the same space could be doing well. And so these are called sympathy plays, and traders do use them a lot as well in their daily trading. Just because of that, there is a little bit of explosion happening in the surrounding area of the industry, really. And so yes, I was looking at NIO when it was back at 6 because it was a sympathy play to Tesla. That said, I never liked the fact that the company wasn't making money, and I do like growth, but I'm a little bit cautious when I'm about to bet in companies that are not making money yet. Now that doesn't mean the company that doesn't make money or loses money doesn't mean at all that it won't be successful in the future. It's just more risky. It's riskier. So if you're aware of that and you are completely objective about what you're thinking of doing and what you want to do with your money, then it's fine to invest in a company that's losing money. Yet it's important to understand why the company is losing money and whether they are growing. Very extremely important. Is their revenue growing? Are the profits growing? Is the cash flow growing over the years? That's the most important thing, even if the company is losing money. Because a company that's losing money and is investing in itself a lot and it starts to have good growth over the years can very, very quickly increase its holdings and its balance sheet very, very quickly if there's explosive growth. Because growth is exponential over the years. So if you create an exponential function for a 10-year growth, you can see that the company can massively grow if they enjoy good growth rates year over year. So again, I am not against growth. I actually love growth. Very, very important. Important. However, I like to purchase companies, and every company has its price. I like to purchase companies at a decent price for me. I want to pay less, and I want to buy companies before they are hyped. So if I bought it here, I would be golden. But right now, this is a different story. And it's good for a new investor that the company was at 60 because there is this previous level here, which is sort of like a resistance and a support potentially later in the future. And so when the stock goes down, it potentially gives us entry points because we don't want to be buying at all-time highs as value investors. Regardless of that, we want to examine the financials a little bit, see how the company is doing and whether it makes sense to buy now, or maybe we should wait it out a little bit. That's also important. So let's take a look at the company's outstanding shares here, which is 1.6 billion, and you will see that NIO has been diluting investors a lot, and it's something that I don't like. Lately, it's a little bit better. Oh, this is like no, that's actually a few months. So yeah, they have been diluting investors a lot. So that's not great to see, because if you are holding stock here, and they keep actually adding more stock to the market, they are severely diluting you, and this could reflect in the stock price at some point. Like right now, there is a lot of hype around the stock, and remember, hype plays a very, very significant role in the stock price, because the stock price for a specific company is not necessarily reflective of what the company is doing financially. Many times it's not. And it could be in the upside or the downside. Like a company could be doing awesome and have a terrible stock price. And the opposite, vice versa. A company is not making that much, but has an awesome, very, very high stock price. Now, in this case, let's take a look at what the company is doing financially. and we will examine the income statement a little bit and see what the company is doing. Let me actually adjust my data here, just to put it from 2017. I think it's fair to have as much data as possible. Yeah, this is a recent IPO, I guess. But you will see here, and this is what I really like about this company, the massive year-over-year revenue growth. That's a very, very good thing, because it means that the company is selling a lot of cars, and actually their cars are awesome. I personally I like them a lot, and I think they're a very, very close competitor to Tesla in how nice they look, if not better even. So I do like the cars a lot, and I could potentially see myself buying one later at some point. And look at this thing here, the gross profit growth over here. This is insane. It's like amazing here. Obviously, the company won't keep growing at this rate. That's impossible. But this kind of growth is insane. It looks like the company has been hyped a lot, and that shows in the year-over-year growth of its revenues and gross profit. And the thing is, the company, if you take a look at its net income, let me find it here. It's still losing money. However, again, that's not necessarily the last thing that you should be looking at and be like, okay, the company is losing money, we are done, I'm not buying it. No, because there is always a price. Now, is this the price? We can examine that and think about it, but let's take a look at the balance sheet first. So the assets of the company seem to be growing. Now, we don't necessarily give too much attention to that, because we want to see why the assets are growing, and you see that the total equity here also growing a little bit along with the liabilities of the company. But you will see here, for instance, the additional paid in capital. So that means that the company issued shares, issued stock, and received capital from investors. So it has been funded by investors a lot, and you would expect that from a new company. That's not a huge deal, but you don't want to overdo it. You want to at some point have the company basically get its money itself from its revenue. And so here the cash flow from operations is a notable thing as well, because it's been growing and actually reaching a positive operating cash flow here, which is very nice to see, because the company used to lose a lot of money. So this implies that right now the company is becoming profitable and much more interesting to investors, especially for this kind of growth. So that paints a little bit of a different story. And again, if NIO was $60, that would be a completely different thing. I definitely wouldn't even think about buying there. But now that's also a different story. We need to examine it, because it's 50% down, and that matters a lot. Because it's different to buy something that costs $100 for $150, and it's different to buy it for $50. Because as an investor, you want to find the best value for your money. That's all it is. And you define that, you decide that based on what the company is currently doing and what is projected to be doing in the next few years. That's how you do it. That's all you can do with a company. And you compare that to the current stock price, and that's how you make a decision. And that's what a sensible decision should be for purchasing a stock or selling it. Cash from financing, a lot of positive values here, which is not great. Basically, a lot of more debt and more issuance of common stock, as you would expect. It's basically what's happening here. Here, for the most part, the company has been selling stock like crazy. We saw that in the outstanding shares. Hopefully, at some point, this will stop, because we will need to have some steady outstanding shares for investors. And the free cash flow used to be as well really bad here, losing billions of dollars, but now it's going back into positive territory, and close to zero here, losing a little bit in the last 12 months. Interesting. So the solvency, I'd expect it to be relatively low. Yeah, it's still not that low, but because the company has been financing itself from investors for the most part, I would expect it to be safe in terms of bankruptcy. Yes, there's not much debt here, so that 70% total debt to equity, I guess it's slightly high, but not that high. So I think it's that's fair. That's not a huge issue. Now, what am I doing with this one? And I have created videos in the past, at different price levels for NIO as well. And it's very interesting because NIO keeps dropping a little bit, although it's up today. And this happens a lot with these types of hype stocks and sometimes overhyped stocks. And Tesla and NIO are two stocks that have been massively hyped. And again, NIO was started as a sympathy play for Tesla, but its financials are growing and it's getting better and better actually. Now, I do like buying companies when they are lower and a little bit undetected. So this one is currently in a trend at the moment. So I would expect it to even go up from here. However, I don't know if I would be willing to actually enter here and ride the wave if that ever happens. I would, however, be very, very willing to consider buying and getting into NIO if it were to fall at like $20 or so. That would be a different story. So that would make me much more prone to entering NIO. And basically, I want a better valuation just because right now the company is not really making cash flow, and so this is a play that's 100% based on growth for the future. And it's a completely different story if you want to buy the stock and trade it for the short term. Like if you're taking a look at the fluctuations of the chart and the daily charts and doing some day trading or swing trading, that's a completely different story. But if you're looking to get it as a value play, as an investor's play, then you have to be cautious and examine what the company could be doing objectively in terms of its financials. And in order to do that, you basically have to rely on the growth that the company has right now, which is tremendous. Because the current stock price based on what the company is doing in terms of its free cash flow and its financials is very expensive. That's a very expensive stock, and the market cap is very lucrative for what the company is making in terms of money. It's basically based on growth, and that's it right now. That said, I would and I will have NIO on my shortlist, and I will be making more videos about it for sure, because it's very interesting. And maybe at some point, maybe if it keeps going down a little bit, it's not impossible at all that this will keep happening. Maybe we can add a little bit to my portfolio at least. So hope you enjoyed this video. If you did, please leave a like and subscribe. I will be making more about NIO for sure. Very interesting stock. And in the meantime, you can also watch this video that I made about Turo and its new IPO filing for 2022. And hope you enjoyed. I'll see you in the next one. Bye bye.